Hello everyone, welcome to my lecture on Unit 4 Topic 3 Accounting Concepts and Conventions. The financial statements that are prepared on the basis of the number of assumptions, conventions and policies commonly known as Generally Accepted Accounting Principles, that is GAAP. Several accounting bodies such as FASB, is Financial Accounting Standards Board, which is a private and not-for-profit organization that creates and maintains accounting standards for public and private companies. Next one is AICPA, that is American Institute of Certified Public Accountants, which is a national professional organization of certified public accountants, which issues authoritative standards especially through its auditing standards. Accounting standards. Next accounting body is ICAI, that is Institute of Chartered Accountants of India, which regulates the profession of chartered accountancy in India. So these are all the accounting standard accounting bodies, and other 15 equivalent in other countries such as Australia and Britain follow these principles, that is nothing but generally accepted accounting principles, that is GAAP. The following sections deals with the important accounting concepts. The first one is business entity concept, going concern concept, measurement concept, cost concept, accounting period concept, as well as matching concept and dual concept. The first concept, that is business entity concept. Here, the business entity concept tells us or explains about what is a business entity. It is nothing but it refers to a legally recognized organization that engages in commercial, industrial or professional activities with the aim of earning profits. It can be a sole proprietorship concern or a partnership concern or a corporation or a limited liability companies or any other legal structure recognized by the government can be termed as a business entity. It might also be referred as a type of business or business model. And now this particular concept, that is business entity concept, basically focuses on the accounting principle that treats a business and its owners as a separate entities, and its owners as separate entities. That is, business transactions are recorded separately from that of the owner's personal transactions. That is the differentiation it is going to be. It is applied in case of a business entity concept. Next one is going concern concept. It is assumed that every business firm continues forever and it has a perpetual life, that is a eternal life. That is, it is not going to be get liquidated or closed down in a near future under whatever may be the circumstances. Like if any of one of the board of directors are exiting from the company, or any one of the partners are exiting from the company, or if any one person doesn't want to continue in the firm as such, under all this general circumstances that are encountered in the process of conducting the business, this particular concept sticks on that, or it implies that there will be a continuation of the business activities without any break. Next one is money measurement concept. Money measurement concept is an important accounting concept that is based on the theory that a company should be recording only those transactions that can be measured or expressed in monetary terms in the financial institute or on the financial statements. So the non-monetary transactions will not come under the purview of accounting or under the purview of financial statements. Cost concept. The cost concept in accounting is the idea that the assets should be recorded at their original purchase prices, otherwise called as historical cost, instead of their current market values. Next one is realization concept. This particular concept is said to be will be mentioning about the revenue that is said to be realized only when the sale is made, not when the sales proceeds are collected. Now, what are the sales proceeds? They are nothing but it is the amount of cash a company or individual receives from selling goods and services over a specific period of time, which can be ascertained as a number of units sold into multiplied by the rate of the each unit. Then next one is accounting period. Now there is a particular specification regarding the maintenance of accounting period for every company, which has to be strictly followed consistently. So generally the accounting period such as can be selected from January 1st to 31st December. It's a one accounting period, or the 1st March to 1st April to 31st March of the following year. And accounts are prepared periodically at least once in a year to find out the profit or loss for the given period of time or income tax purposes. Or accounting period can also be for a half a year or a quarter year also. Matching concept. It states that the expenses of a given period must be related to the revenue of a particular period only. That is, the revenue earned for the period must be determined first, and then the expenses are to be matched to the revenue earned during that given period. The outstanding amounts or the advances which are received in any of the cases will not be considered for that particular year for which the financial statements are prepared. Dual aspect concept. The dual aspect concept indicates that each transaction made by a business impacts the business in two different aspects which are equal and opposite in nature. That is, for every debit there will be a corresponding equal amount of corresponding credit. Now coming to the next concept, that is accounting conventions. These are the 4 different accounting conventions generally which are implied for a accounting purpose. One is consistency, next one is full disclosure, materiality, as well as your conservatism. Coming to the first one, that is consistency. A company should apply the same accounting principles across the different accounting cycles. Once it chooses a method, it is urged to stick with it in the future unless and until it has any good reason to change that particular accounting principles. So the frequent change in the accounting principles may not give an authentic information, which ultimately affects the decision making processes. The next one is full disclosure. Full disclosure, or else we can also term it as transparency. Information considered potentially important and relevant must be revealed regardless of whether it is detrimental to the company. That is, it suggests that a business should report all the necessary information in their financial statements which benefits both the creditors as well as the investors and other stakeholders. The last conventions, that is materiality. Similar to the full disclosure convention, this talks about considering only that aspects or that information which matters and something that is important and significant. The other irrelevant things should be out of the purview of the accounting process. So, if for example, if an asset or even is material that is important, then it should be disclosed. The next one is the last convention is conservatism. This convention states that we should not anticipate, or the firm should not anticipate a profit before it's realized, but provide for all possible losses which might occur in the course of business. This particular convention is also called as doctrine of prudence. So this is all about your accounting concepts and conventions in this particular session. With this, I'll end up the session here. Thank you.